we have a panel of special guests joining us this morning. Feroz Aziz, thank you so much for being here with us this morning. We also have Kranti Batini and we've also got Devang Mehta. Gentlemen, what a pleasure. All of you joining us on this very important day. Let's look at the charts and let's look at the numbers. And it seems that perhaps the response to the massive reforms that we heard about yesterday could have been a little better on the markets. Markets still, while they're higher, seem to be a little muted in their response. Feroz, let me understand from you first. What's going down with investors? Why aren't we seeing as much bullishness as we could have potentially seen?
Yes, Karthik, like you rightly said, we could have seen larger gap ups on situations like these. But there has been a sentiment which has not been so positive, right? When you see some good news, it takes time for that to catch momentum. Now, if you see 92% index short of FII yesterday, you know that there is pessimism on one big elephant who's there in the markets, right? You have DIIs, you have FIIs. FIIs are three kinds, DIIs are several kinds. So if you break it down, you need some big people to start buying. Domestic is always kept buying. So FIS got overwhelmed with what is happening globally. So that's why you don't see large gap ups.
All right.
And that's good for the market.
Okay.
Second, you're seeing that markets have already gone through a reasonable time and price correction. So these are very conducive environments for a structural reform like this to come in. And this will have an impact, very long-termish impact, because there's so much GST input tax credit fraud, which the government has unearthed. You will see not so much of a drop in the GST collection, but a lot of formalization. All these leakages can get plugged, and that's when listed companies who are already at the epitome of governance get benefited. So that will be a long-termish kind of thing, but the sentiment has a lot of other dampeners, is why you don't see a 400-500 point Nifty gap up.
All right, so there are dampeners. All is not well, especially as far as global investors and their mood is concerned. Mr. Devang Mehta, I want to bring a few sectors into focus this morning. And the first one, of course, is the auto sector. There was fear that perhaps there is going to be an additional tax on electric vehicles, which are priced between 20 to 40 lakh rupees, and that was playing on investors' minds, especially on Tata Motors and Mahindra. But the government has pretty much kept that unchanged, and the flat 5% on EVs continues to stay. Meanwhile, even the bigger cars, the more than 4-meter cars, more than 1500cc diesel vehicles are now taxed at 40%, up from 28%. But the cess is going to be done away with, in effect making cars over the entire spectrum cheaper to buy for consumers. And now, just ahead of the festive season, we are seeing that there could be this double bonanza when it comes to automobile purchases. Mahindra is up about 6.5% or so in trade this morning. Tata Motors is also inching up higher, up about 1.4%. As far as the auto sector is concerned, it has seen its own fair share of volatility over the last few months. Where does it go from here, sir?
Good morning. Thanks for having me on the show. I think, yes, clearly, I think consumption was one thing which was suffering the last few years. What we have seen in the last September to this September, right? So 1 year, we have only seen volatility coming to the fore. We saw so many negative events, geopolitical tensions, Trump tariff tantrums, and probably the last...
which haven't gone away, sir, and God alone knows whether they will or will not go away.
Yeah.
I think those concerns have not gone away. The volatility with respect to geopolitics continues to stay, sir, continues to mar investor sentiment.
Exactly. So that stays, of course. But most importantly, the macros, the Indian macros and the Indian micros are now coming to the fore. So right now, what you clearly saw is that government giving boosters in the form of budget, right? Some budgetary support was given to the upper middle class, and even in the class who pays taxes. So that was one part which helped not only the motors, but it also helped people sort of carve out their strategy in terms of investments. Second most important part is that government also admitted that the capex was slow in the last year and that capital expenditure started to move. The missing link was consumption, right? The missing link was sort of rural India not doing what it was doing, animal spirits 4-5 years back. That probably could now come back to the fore. One with good monsoon, one with good macros, one with RBI supportive, with government supportive, with this GST sort of reforms. I think this is mega. And what I was meaning to say was that the 4-5 events that have played in the market, right from India upgrade by S&P to GST, important news on GST to RBI rate cuts. All these things have sort of got in the background because the sentiment has not been so great. But
Right.
I think very clearly the headlines is that 5 lakh crores put in 2 years consecutively by the DIIs, domestic investors, is something huge. FIS probably would come in the next 3-6 months. It's a difficult guess to make. But I think for the auto sector, probably it's very positive. For FMCG also, extremely positive.
All right, Kranti Patini, let's talk about the FMCG sector then. We have discussed auto. FMCG sector, a mixed bag that I can see on the screen this morning because while you have ITC up 2% despite the 40% sin tax on tobacco, that seems to be one anomaly. The other anomaly is that Tata Consumer is incidentally down about 0.4 of a percentage point. Why do you see this discrepancy and what does this tell us about the mood on FMCG stocks?
Yeah, Karthik, good morning to you. The stocks have been in a consolidation phase from the past 18 months. The current GST reforms on a longer term basis definitely will be booster stroke for these all FMCG companies. But if you look at the companies, these stocks have been rallying in the recent past. So some kind of a consolidation is taking place for some companies. You look at the Bajaj Consumer, which is more into hair oil and all. So these are the companies definitely going to take the benefit in the medium to short term and also for the long term. So there is can be some kind of a divergence. And after the announcement of these tax rationalization is concerned, these stocks have rallied in the recent past. So some names, we can see some kind of profit booking that's taking place at this point of time. As you mentioned, ITC, the sin, as you rightly mentioned, the influence of the sin tax is high. Normally, the sin tax comes up with inelastic price demand. That is the reason you can see, despite of increasing in the tax, you can see the uptick in the stock. So by and large, FMCG business is growing up business and it's dominating. That's where it's going to have a positive impact on the stock on the medium to long term. So there can be some kind of a divergence at this point of time. But overall, it's definitely going to be benefited for the consumer stocks in the medium to long term.
All right, medium to long-term view is that this is going to be a positive. Feroz Aziz, I think one question that many retail investors grapple with is the fact that 1 year ago, in fact, just 20 days or so to go for that 1-year anniversary of Sensex Nifty touching new highs. Now, 1 year on, they are still sitting at losses, notional losses of about 3% or so. At one point of time, 3 months, 4 months ago, when we were still hot on the trail of signing that trade deal with the United States, there was an assumption that by the month of July, August, we will reclaim those levels. But that seems to be a distant dream right now. For the retail investor, what should be the strategy at a time like this? We have a festive season coming. There is absolutely no clarity on whether the 50% tariff on India is going to go or not. And then, of course, we have this great consumption boost by way of GST. What should the retail investor at this point do?
Karthik, let me get a little comparison with real estate before I get there. So we all use these proverbs, no pain, no gain. But when it comes to equity, none of them seem to be working when it comes to human immersion, right? All of us are sitting on some real estate. Did we ever compute what was the per annum every year's financial year return for the real estate which I'm sitting in, Mahalakshmi? The answer is no. When it comes to equity, people want a positive return every single month if possible. So if for the last 1 year, if markets have not delivered any return, but the previous 6 months, Nifty had delivered 18% from 1st of April, almost 18% from 1st of April till 24th September 24, which is where it touched 26,217. So point one I'm making is, if you want to make 3 times more the FD return, you will have to be prepared for some degree of sideways movements. In the 1 year, it has done a lot. Nifty went to 21,700 twice on the election day and then somewhere in March. Both the days I came on your channel or
I remember
days
that.
Here and there.
I remember
and I
both
said,
the days.
Bhai, these are purchase opportunities.
Yeah.
These are purchase opportunities and they continue to be that way. Third, now what should one do? That's the more important question. I personally think you should look at principally what is going to happen 3 years from now, 5 years from now.
Okay.
So the GST rationalization will immensely benefit listed equity. Because anybody competing with some degree of lack of corporate governance goes into trouble.
Okay.
So these listed FMCG companies, find a lot of benefit because they were anyways not using any loopholes. So that becomes more a big competitive edge.
Right.
Second, consumption as a theme, which Devang sir also spoke of, all right, where you see there are about 5, 6 subsectors, it's a good opportunity because seldom does it happen that there's a sector in flavor, but the last 1 year return in that sector is minus 2%. There are
That's right.
27 funds in the consumption theme, and the AUM is 18,000 crores moved up to 35,000 crores.
Okay.
There are some active managed consumption funds which focus on 6 subsectors. Consumption is nothing but for the benefit of viewer because we speak in Greek and Latin to a viewer sometimes. I was hearing two oncologists speak, it intimidated me. What are these? Similarly, consumption is any business which sells directly to a consumer
That's right.
rather than to another business. So you have FMCG, you have automobile, you have apparels, you have telecom, you have textile, tourism, and then you have healthcare.
Right.
These 6 sectors, there are 27 funds, and consumption has given you minus 2%. And if you really want some thrill in your portfolio, that is, if you really need some thrill, then you can go for a consumption sector fund. Because the rear view mirror is not so positive, but the front view is so much more positive, and this is seldom which happens. If people recommend defense funds, you look back and you see 30%, 40% return in 6 months, and then you feel scared that you're buying it at the fag end of the rally. That's what a retail investor, first time you might get a thrill without entering last. That's the consumption sector fee.
All right, Mr. Devang Mehta, I want to take this analogy of rear view mirror and the front view of the car forward with you. Now, investors always look at data, right? They always look at what has happened in the past. And the story for new investors for the last 1 year does not seem very positive at all. They're still putting in their money because retail investments are only continuing to grow. But the point is, without looking at the back, how does the retail investor really figure out which are the right sectors to invest in the future? Because, of course, consumption and the consumption basket that Feroz spoke about and you also referred to earlier looks great. But at a time like this, should I look at, let's say, the IT sector with the hope that, hey, you know, there is going to be a rate cut in the US and there is going to be better acceptance and deployment of AI by Indian IT companies? Or should I look at the banking sector that perhaps there is going to be another rate cut, there are going to be better net interest margins for banks? How does the investor really not look at the rear view mirror, which is fairly foggy for the last 1 year, and still continue to drive ahead with their investments?
I think it's a very good question, and I think I sort of would continue it from where Feroz left. So I think very clearly what happens is rear view, one looks at for filters, right? So what we look at is when we look at the rear view, that what has done well, what has not done well. Most importantly, you want to filter sectors, themes, and stocks on filters as per rear view. Now, what is that? You want some consistent profitability growth, revenue growth, EBITDA growth, margin growth. You want companies to either gain market share, retain market share, and most importantly, ROEs. ROCs are the step that we look at before we come with a universe list. Now, once you have this list, you also look at the front mirror, or you look rather at the windshield. Right, windshield is the most important part, but because finally markets are forward-looking, markets start to discount things earlier. Then what is looking good going forward? That's most important. And as per your question, one, yes, the GST gives a lot of boost to consumption, which was sort of suffering, which was sort of in doldrums in the past 3-4 years. That gets a boost. I think India now runs on 3 wheels. Very clearly, it was consumption only earlier. Now it is capex. Capital expenditure is the word that we use very rarely earlier, but now it is used widely. So one is capex, the second is credit growth, and the third is consumption. As I always say, these are the 3 C's on which India runs on. Very clearly, I think if consumption is getting a boost, your capex will get a boost and your credit growth will also sort of get a boost. In credit growth, I don't mean only banks, except of banks. So I think if you X banks also, there are so many other sectors, like the financial world, intermediaries, brokers, wealth management firms, exchanges, depositories. I think this also tend to benefit. While people will have purchasing power with them, they would also sort of invest more. And with investments with this, also the capex, manufacturing, engineering, all this theme will come to the fore. I think probably it's a very sweet time. Earlier, it was only one theme which used to do well. 25 years, if you look at history, it is only IT, consumption, bankings, and pharma where Indians would have made money. But I think there are a lot of new sectors opening up, a lot of new sub-sectors, micro sectors opening up where I think there is a lot of opportunity to make money.
All right, a lot of new sectors, subsectors, opportunities to be exploited. Well, final question to you, Kranti Batini. I'm not going to Feroz with this one because I know his view, and in fact, 2.5 months ago, perhaps I should not have agreed with his view nodding on a stage in Dubai where I asked him a question on gold. But Kranti, my question to you is that gold has continued to be absolutely, this one hedge which is refusing to get cut, and gold prices are continuing to soar and breaking new records at a time when we could potentially, I'm not making assumptions here, but we could potentially in the next few hours, next few days, see profit booking on the markets, on the stocks which are rising today. Gold is something that people are continuing to invest heavily on, and with the Diwali season, festive season around the corner, some estimates are suggesting that gold could go as high as 1,08,000, 1,09,000 rupees per 10 grams. Now, compare this to earlier this year, gold touching that 1 lakh figure, and we were saying, oh wow, gold is at 1 lakh. Now it's already giving, an excess of almost 8-9% on that value. So between equity class, between debt instruments, given that rates are coming down, and an asset class like gold, looking at the price charts today, looking at the stocks today, what is your view on gold for retail investors?
Karthik, first and foremost is on a longer term basis, wealth creation happens in equities. Equities tend to outperform on a long term basis. Of course, we tend to come across these kind of aberrations in a medium to short term or a longer term basis in kind of a escalating geopolitical environments are concerned. The precious metals, it can be gold and silver, tend to outperform. But equities on a longer term basis, equities outperforms any asset class. There will be some periods of aberrations like the current period, what we witnessing like the war times and all. We can tend to see because of the nature of these precious metals, okay, they tend to outperform in the medium to short term. But the longer term view is concerned, okay, equities outperforms any of the asset class, but there should be a percentage of asset allocation towards the silver and gold. That should be the part of the overall asset allocation and fund allocation is concerned. But
Right.
equities always in a longer term basis, it's a volatile assets. Everyone knows, but it is a rewarding asset also.
I can see Feroz nodding and smiling in agreement. Gentlemen, I'm so sorry I've completely run out of time, but thank you so much for joining us here this morning. Feroz Aziz, Joint CEO Anand Rathi, Kranti Batini, Equity Strategist, Wealth Mill Securities, and Mr. Devang Mehta, Deputy MD, CIO, Equity, NDPMS. Thank you so much for being here with us this morning.